It's also important to stress test plans, to introduce difficult markets and see if the results change. So here we have a case where we've introduced a 2008-like market prior to retirement and seen what effect it takes on the plan. And you'll notice that while this particular couple gets 15 years of the retirement they like, their portfolio is exhausted, and after that, they are forced to live within their guaranteed sources of income, such as Social Security and pensions, which is a very difficult thing to do. Finally, we come to the most sophisticated way to look at market variance, to take into account the good markets, bad markets, and all the markets in between, and that is Monte Carlo analysis. What Monte Carlo analysis enables us to do is take the past to imagine the future. It crawls back through market history and randomly recombines return intervals to imagine the statistical equivalent of 10,000 iterations. The graph that you're looking at right now is a spaghetti graph, and each of those gray lines represents a different possible scenario. Monte Carlo analysis is nice because after running the statistical equivalent of 10,000 iterations, you can see how many worked and how many didn't. And that's a powerful place from which to make major decisions in your life. There's one more practice that I want to sneak into this webinar that I think is worth beginning in order to bring you closer to your goals and build momentum in your plan and in your life. And that is to become aware of certain changes that occur over time. Those changes occur in spending, income, and savings. Within the domain of spending, there's mortgage payments. Many of our clients will see the day where their mortgage payment stops because they have paid their mortgage off, and that creates tremendous spending relief and makes a big difference in plans. Insurance premiums, as you move through life and you accumulate and gather obligations when you get married and have children, you need to make sure that your insurance coverage is appropriate to taking care of those concerns. There is a point, however, that you reach where your existing resources might be able to shoulder some of the burden that insurance used to shoulder, and that opens up an opportunity of reducing living expenses by reducing insurance premiums. Then we come to medical expenses. For those who aspire to retire, say, in their 50s, there can be a spike in medical expenses that is created in that period. People who retire in their 50s have to wait until they're 65 before they can become eligible for Medicare, and it's important to incorporate that added expense through that period. In the domain of income, it's very important to be aware of pensions and Social Security, when those start, and with regards to pensions, whether those carry an adjustment to inflation with the pension payments. Also in the domain of income is transitional retirement, a term that's used to coin how we're seeing retirement change these days. People are still very interested in stop working for money, but they're not as interested in stopping work altogether. So a transitional retirement, either taking on part-time work or a different role altogether but still earning income, can be a powerful element in a plan because what you earn does not need to be taken from your portfolio. That brings us to real estate, which could have just as easily belonged in the spending category. Real estate can often be a tremendous boon to financial plans, but it can also be a danger to them. If the cash flow is negative, it's essentially another line item in your spending. And finally, we come to savings. There's a myth out in the marketplace that if you just maximize your 401k contributions, that your successful retirement is assured, when in fact other kinds of savings are necessary. The one that's most important as you approach retirement is to make sure that you're building cash reserves, up to ideally 2 years of living expenses in cash reserves, which is something worth working on and concentrating on because it is difficult to achieve. So here at Bell Investment Advisors, we offer help around the practices that we've discussed today to begin and quit. For our existing clients, we offer budgeting work for a one-time $500 fee. We also help clients look at multiple markets and their impact on a financial plan through our retirement planning process and our financial outlook process, which are both $1,000.
Great. Thank you, Forrest. That completes the formal content of our webinar today. On this screen, you see that most of our past webinars are available on our website. A recorded version of today's webinar will be available in approximately 1 week, and we will notify you via email of its availability. Our next webinar will take place on May 25th from 2 to 2:30. That will be our investment committee update with our Chief Investment Officer, Matt King. That's for clients only, not for prospective clients. So please join us for that. We will be sending you a survey in a few minutes about today's presentation. Your comments are really helpful to us, and we'll make sure that we answer your questions and get back to you. So we do have a couple minutes left to take a few questions. Please stay in touch with us and contact us with any way that we might be able to help you. Forrest, what's the first question there?
There's a question here about assumptions. What assumptions do you use for your plans? I presume that relates to inflation, investment returns. So we use a 3.1% assumption for inflation. That is a solid average over the last 100 years of history. Inflation rates vary depending on the historical range that you're looking at. We prefer, with regards to inflation, to take a very long view and think the 3.1% figure is sufficient and grounded. With regards to investment returns, when we're looking at stress testing and straight line plans, we're just fixing the rate of return at a 5% real return. With Monte Carlo, we're not doing that. We're taking our clients' investment allocation, we're customizing the software to reflect the volatility and returns that we would expect, say if they're using Class 3 and Class 4, and we run the Monte Carlo from there.
Great. I see a question that just came in about what if I just want to focus on my retirement? Definitely that's an area that we address. We're flexible in that regard. Our retirement outlook program for $1,000 would address that specifically. I see there's another question. What was that third one, Forrest, that we were going to ask off our list here? Yeah, what is the best age to start financial planning? Obviously, sooner the better. And sometimes retired clients want to know if they should go ahead and do a financial plan. And again, we're flexible on that. It's a personal choice. If it helps you sleep better at night to have specific benchmarks and a roadmap about the future and have that a probability analysis with stress tests and crash tests, by all means, it's worth the money, and we feel our fees are very reasonable on this. So again, it's personal. I just met with some clients this morning that they're fully retired. They have 2 years in cash reserves, 2 years of living expenses. They're withdrawing 5% or less from their critical mass. They're fine. We meet every 3 months. They really don't need a specific plan, in my view. But we all kind of agree about that. So we show a lot of flexibility here. Thank you for attending today. Please keep in touch. Visit our website. Follow us on Twitter. Check out Bonnie Bell's Career and Life Coaching blog. Email us or call us with your questions and answers. Thank you for joining us. We'll look for you on, I believe it's May 25th with our investment committee update. Thank you.